U.S. banks teetering on the brink of collapse. In a chilling revelation, a finance expert from Florida Atlantic University has unveiled a dire analysis. More than 300 banks are at higher risk of failure. The culprit? Their alarming exposure to commercial real estate loans or CRE loans. Dr. Rebel Cole, an eminent scholar in finance, has raised the alarm, emphasizing that these banks are grappling with CRE exposures that exceed 300% of their total equity. This figure, derived from the bank's first quarter 2024 regulatory data, is a harbinger of disaster, as CRE loans are being repriced in an unforgiving high-interest rate environment. With commercial properties plummeting in value, regulators will soon compel these banks to write down their colossal exposures, potentially triggering a financial catastrophe. Understanding the risk, simplifying the numbers. What does 300%, 400%, 500%, and 600% exposure mean? To grasp the gravity of the situation, consider this. When a bank has a 300% exposure to commercial real estate loans, it means it has lent out 3 times more money in risky loans than it has in its own financial reserves or equity. If these loans go bad, the bank's financial cushion is obliterated. Now imagine the catastrophic scenario where this exposure climbs to 400%, 500%, or even 600%. At these levels, even minor fluctuations in the real estate market can spell doom. Equity versus deposits. What's the difference? Equity, also known as the bank's capital or reserves, consists of the bank's own money. This includes the money invested by shareholders and the profits the bank has retained over time. Equity acts as a financial cushion to absorb losses and keep the bank solvent. Deposits, on the other hand, are the money that customers like you and I put into the bank. These funds are technically liabilities for the bank because the bank owes this money to its customers. If the bank faces severe financial trouble, these deposits can be at risk, especially if the bank fails and the FDIC insurance is insufficient. The imminent threat. Flagstar Bank, with an exposure of 553%, has lent out more than 5 times its equity. This is, well, a ticking time bomb. If the commercial real estate market falters, Flagstar's financial foundation could collapse overnight. Zion Bank Corporation, at 440% exposure, is in a similarly precarious position. A modest dip in property values can push the bank to the brink of insolvency. The domino effect, a systemic crisis. The U.S. bank's exposure to risk from real estate, part of FAU's banking initiative, reveals a terrifying picture. Over 1,871 banks nationwide have CRE exposures exceeding 300%, with hundreds surpassing 400, 500, and even 600%. The financial system is a house of cards, vulnerable to the slightest tremor. 1,112 banks have CRE exposures greater than 400%. 551 banks have CRE exposures greater than 500%. 243 banks have CRE exposures greater than 600%. The FDIC safety net, woefully insufficient. The Federal Deposit Insurance Corporation, FDIC, insures deposits up to $250,000 per account, but with total insurance coverage of only $119 billion, the FDIC is grossly underprepared for a banking meltdown of this magnitude. If these overexposed banks begin to fail, the FDIC's resources will be swiftly overwhelmed, leaving countless depositors unprotected and potentially penniless. Dr. Cole warns of an impending domino effect. If just one more bank fails, it could trigger a widespread panic. Depositors, fearing for their savings, will rush to withdraw their money, leading to a catastrophic bank run. The closures of 3 major banks in spring 2023 were just the beginning. The threat of a far-reaching financial crisis looms larger than ever. In the event of a bank failure, not only are your deposits at risk, but you could also be subject to a bail-in. Unlike a bailout where the government provides financial assistance to save a failing bank, a bail-in uses the bank's creditors to absorb the losses. As a depositor, you are considered an unsecured creditor. This means the bank can legally convert your deposits into equity, shares in the bank, to recapitalize itself. In simpler terms, your hard-earned money could be used to save the bank, and you might end up with worthless shares if the bank's value continues to plummet. The concept of bail-ins was formalized in the United States with the Dodd-Frank Wall Street Reform and Consumer Protection Act passed in 2010. This legislation was enacted in response to the 2008 financial crisis, and includes provisions that allow regulators to implement bail-ins as a way to recapitalize failing banks without using taxpayer money. This means your deposits could be converted into equity to stabilize the bank. The harsh reality: your money is at risk. This is not just a hypothetical scenario, it's an imminent threat. The stability of these banks is hanging by a thread, and the risk of collapse is immediate and severe. The financial system is more fragile than ever, and the danger of losing your hard-earned money is real and pressing. Don't wait for the storm to hit. Act now and protect your assets before it's too late. The safe haven: physical gold and silver. In these tumultuous times, there's one investment that stands above all others: physical gold and silver. Unlike cash in the bank or paper investments, physical gold and silver have no counterparty risk. They are tangible assets that you can hold in your hand, giving you true ownership and control over your wealth. Gold and silver have been trusted stores of value for millennia, surviving every financial crisis and economic collapse. They are not just commodities, they are money in its most enduring form. When banks are on the brink of failure and financial systems are collapsing, gold and silver offer unparalleled security. Be your own banker. If you can't hold it, you don't own it. This old adage has never been more relevant. By investing in physical gold and silver, you take control of your financial destiny. You become your own banker, immune to the failures of the financial institutions that are crumbling around you. For over 4 decades, Swiss America has been a trusted partner in helping individuals protect, preserve, and privatize their wealth with physical gold and silver. Our expertise and dedication ensure that our clients receive the best possible guidance tailored to their unique financial goals and family needs. In these perilous times, the urgency of safeguarding your assets cannot be overstated, especially with the looming banking crisis driven by widespread commercial real estate loan defaults. This crisis is unfolding now, whether you believe it or not. Federal Reserve Chairman Jerome Powell has warned of inevitable bank failures, and FDIC members have openly discussed the likelihood of bail-ins. Ignoring this reality won't make it go away, it only puts you at greater risk. Being proactive is essential. It's better to be 6 months early than a day late, because once you're reactive, the damage is already done, and your money could be lost. Now, more than ever, it's crucial to move your money out of vulnerable financial institutions and into the stability of physical gold and silver. That's why we offer a no-obligation, purely educational consultation to help you make informed decisions about securing your wealth. Join the tens of thousands who have trusted Swiss America to provide a solid foundation for their financial future. Call today at 1-800-289-2646.